If you're using a VA home loan, you're already getting one of the best mortgage products available. No down payment, no private mortgage insurance, and competitive interest rates. But there's one cost that catches a lot of borrowers off guard, and that's the VA funding fee. Today, we're going to cover what it is, why it exists, and how it's calculated across every scenario, who is completely exempt from paying it, how a down payment can lower it, and something most borrowers don't even realize, that you may not have to be the one that pays it at all. The VA funding fee is a one-time fee charged on VA guaranteed home loans. It is not paid to your lender. It goes directly to the VA, and its purpose is to keep the VA home loan program running and available for future generations of veteran and service members. Congress established the funding fee so the program can sustain itself without relying entirely on taxpayer funding. Without it, a program that allows veterans to buy homes with no down payment and no mortgage insurance wouldn't be viable long-term. The fee is calculated as a percentage of your total loan amount. It's not a flat dollar figure. It scales with the size of your loan. The exact percentage you pay depends on three things: your military service category, whether this is your first time using the VA loan benefit or if it's a subsequent use, and whether you make a down payment and how much that down payment is. The fee can be paid in cash at closing, or it can be rolled directly into your loan amount. If you roll it in, it slightly increases your monthly payment, but it means you don't need to bring that cash to the closing table. Either way, it must be settled at the time of closing. One thing worth knowing up front: the funding fee can be paid by the seller, the lender, or any other party on your behalf. And we'll come back to that because it's one of the most underused options available to VA borrowers. Before getting into how the rates work, exemptions are worth covering first because a significant number of VA borrowers don't have to pay the funding fee at all, and many of them don't know it. You do not pay the VA funding fee if you are a veteran receiving VA compensation for a service-connected disability. So if the VA has determined that you have a disability connected to your military service and you're receiving compensation for it, you're exempt. You're also exempt if you are a veteran who is entitled to receive VA compensation for a service-connected disability, but you are currently receiving military retirement pay or active service pay instead. The key word is entitled. Even if you're not actually drawing the disability compensation because you're taking retirement or active duty pay instead, the entitlement itself qualifies you for exemption. You are exempt if you are unmarried. You are exempt if you are the unmarried surviving spouse of a veteran who died in active service or from a service-connected disability, and you are receiving dependency and indemnity compensation. You are exempt if you are a service member who has received a proposed or memorandum rating from the VA prior to your loan closing stating that you are eligible to receive compensation as a result of a pre-discharge claim, meaning your disability claim is still in process, but the VA has already indicated you'll be receiving compensation. That indication alone is enough to qualify you for the exemption before the final rating is officially issued. You are also exempt if you are a service member on active duty who provides evidence on or before the date of loan closing that you have been awarded the Purple Heart. If any of those apply to you, you pay zero funding fee regardless of loan size, down payment amount, or whether this is your first or subsequent use of the benefit. It's worth confirming your exemption status with your lender at the very beginning of the process, not at the closing table. For everyone who doesn't qualify for an exemption, the funding fee is determined by three variables working together. The first is your service category. Active duty service members, veterans, and members of the Reserve and National Guard are all covered under the same fee structure. There's no penalty for being Reserve or Guard versus active duty when it comes to the funding fee. Is your first time using the VA home loan benefit or a subsequent use? First time use carries a lower fee. Subsequent use, meaning any use after your first, carries a higher fee. The third variable is your down payment. Even though the VA allows you to buy with no down payment, choosing to put money down has a direct impact on your funding fee percentage. Putting down at least 5% lowers your fee, and putting down at least 10% lowers it even further. These reductions apply whether it's your first use or a subsequent use. If this is your first time using the VA home loan benefit and you're making no down payment, you'll pay the standard first-time use rate. Your lender will have the current rate, and it's always worth asking for upfront so that you can factor it into your planning. A down payment can work in your favor even on a loan where one isn't required. If you put down at least 5%, your funding fee rate drops noticeably. But if you put down 10% or more, it drops further still to the lowest tier available for purchase loans. While you absolutely don't have to put money down, if you have savings available and you're trying to reduce your overall loan cost, putting down 5 or 10% accomplishes two things at once. It lowers your loan balance and therefore your monthly payment, and it directly reduces the percentage you'll pay in the funding fees. That's a compounding benefit worth thinking about. If you've used your VA home loan benefit before and you're using it again, the fee is higher at the no down payment tier. This applies to any use after your first, whether it's your second, third, or beyond. There's one exception worth noting. If your only prior use of VA entitlement was for a manufactured home loan, the higher subsequent use fee does not apply to you and your fee stays the same as the first time use rate. For everyone else using the benefit a second time or more, the down payment reduction still apply and they're just as significant. Putting down 5% or more brings the rate down to the same level as a first-time user. Putting down 5%, putting down 10% or more brings it to the lowest tier, regardless of how many times you've used the benefit before. So for repeat VA borrowers, a down payment becomes even more strategically valuable, not just for what it does to your loan balance, but because it neutralizes the higher subsequent use rate entirely. The rates we've discussed so far apply to standard VA purchase loans and cash-out refinance loans, but there are other VA loan types that carry their own funding fee rates. Interest rate reduction refinance loans, commonly called IRRRLs, carry a significantly lower funding fee than a purchase loan. If you're refinancing an existing VA loan to get a lower interest rate, the fee is much more modest than it would be what you pay on a new purchase. So a loan assumption where a buyer takes over the seller's existing VA loan rather than opening up a new one also carries a low funding fee. This is one of the reasons loan assumptions can be an attractive option when interest rates are high and the lower funding fee, part of what makes it work financially. The Native American Direct Loan Program, which is VA's direct lending program for eligible Native American veterans purchasing on federal trust land, has its own fee structure that differs from the standard purchase loan rates. For any of these loan types, your lender can provide the current applicable rate, and VA's funding fee tables are publicly available and always reflect the most current figures. The VA funding fee does not have to be paid by you. VA policy explicitly allows the seller, the lender, or any other party to pay the funding fee on your behalf, which means it's a negotiable item in your purchase transaction. In a market where sellers are motivated, asking the seller to cover your funding fee as part of the negotiation is a completely reasonable request. Put this into your offer as long as you communicate that desire to them. The seller's total concessions can be up to 4% on the loan amount, and the funding fee can be part of that. Even if the seller won't cover it, the lender may have options. So if you're receiving gift funds from family to help with your home purchase, those funds can be used towards the funding fee as well. So when you sit down and negotiate your purchase, the funding fee should be part of that conversation, not something that you just quietly accept as your personal cost without exploring your options. If no other party is covering the fee and you'd rather not pay it in cash at closing, just roll it into your loan as a straightforward option. VA allows the funding fee to be included in the loan amount at closing. So rolling it in means you're financing the fee, which means you'll pay interest on it over the life of the loan, which over a 30-year mortgage, that adds up. So paying it in cash at closing costs more upfront, but less overall. So neither choice is wrong. It just depends on your financial situation, your cash reserves, and how long you plan to stay in the home. If you're planning to sell or refinancing within a few years, rolling it in may make more sense. If you're buying for your forever home and have cash available, paying at closing likely saves you money in the long run. So your lender can run both scenarios for you so that you can see the exact difference. The VA funding fee is a one-time percentage of your loan amount that keeps the VA home loan program running for future veterans. It's not optional for most borrowers, but it is manageable, and for some borrowers, it doesn't apply at all. So if you have a service-connected disability and receive VA compensation, you're exempt. If you're entitled to that compensation, even if you're taking retirement or active duty pay instead, you're exempt. If you're a qualifying surviving spouse receiving DIC, you're exempt. If your disability claim is pending and VA has issued a proposed rating, you're exempt. If you've been awarded the Purple Heart and can document it at closing, you are exempt. If you're not exempt, your fee depends on whether it's your first or subsequent use of the benefit and whether you make a down payment. 5% lowers your rate, 10% lowers it further, and those reductions apply whether it's your first loan or your fifth. The fee can be paid in cash, rolled into the loan, or paid by the seller, lender, or any other party entirely, and it should be treated as a negotiable item in your transaction. The most important thing you can do is have this conversation with your lender early before you're sitting at the closing table. Know your exemption status, know your rate, and know your options for who pays it and how. If you're planning to use your VA home loan benefit and want to make sure you fully understand your funding fee situation before you apply, use the link below to book a call with my team and we'll walk through it together. If you want clear, reliable explanations of VA and mortgage programs and how they apply to real decisions, make sure to hit that subscribe button. My goal is to give you accurate information so you can make informed decisions with confidence and ultimately win with Wade. We'll see you next time.